So now we're going to talk about the effect of gamma on delta and option prices. So the first thing, what is gamma? Gamma is the rate of change of delta for every $1 move in the underlying share price. So remember what we said in the previous video, that we said delta is always changing when the share price is moving, and gamma is the factor that delta changes by. Now, the one thing we want to bring to your attention before we move on and talk about gamma is that gamma for the shorter term expiries is much higher than the longer term expiries. So you're going to clearly see that there, that the gamma value gets higher. The net effect of that for you in your portfolio is the closer you are to expiry, the more volatile the option price is likely to be, especially if the value is in and around at the money or just slightly out of the money or in the money. The option price is likely to move a lot for a small move in the share price closer to expiry, whereas the longer term options aren't likely to move as much in terms of their pricing. So let's talk about gamma in greater detail with delta. So let's take again the $60 puts here for July the 15th. We can see our bid and our ask here. We have a delta of minus 0.7658, and then we have this gamma value of 0.0633. So what does that mean? It means that for every $1 rise in the share price of Microsoft in this case, the value of the delta will change by 0.0633. So let's give you a couple of outcomes for that to demonstrate it. So you're looking at a matrix here, and we're saying, okay, here's day one. The share price of Microsoft is at 56.38. The value of the $60 puts is 455 and 460. We've a negative delta of 0.7658 and a gamma of 0.0633. So we've no profit or loss in that situation because we've only just positioned ourselves in the option. But let's say in day two now, the option has decreased in value by $1. Well, you can see that our option price has gone up by the previous day's delta amount. So, if remember, when a share price drops, the delta becomes positive on the options price because a negative one multiplied by a negative delta becomes a positive delta. So 455 plus your 77, we'll round it up to 77, gives you 532, and then 460 plus your 77 gives you 537. But look what happens your delta price. Your delta value has also changed. So now your delta has gone up by 0.0633, and it's gone now to a negative 0.8291. So minus 0.7658 minus 0.0633, because the share price has dropped by $1, will give you minus 0.8291. And the overall profit in that scenario is $72 per share, because we bought the option at 460 and we could now sell it at 532, which would give us a profit of $72. Let's say now we get into day three and the value of the shares drop another dollar. So now all of a sudden we have our new option price, which is 532 plus the 82 cents from the previous day. Remember, the share price has dropped $1, so that becomes a positive delta. And that's 532 plus 83, we'll call it, or 82, becomes 614. And 537 plus the 82 becomes 619. So your new option pricing has gone up by the previous day's delta amount. But again, your delta has changed. Your delta now is gone up again by 0.0633. Now, just for the purposes of this example, we've kept gamma the same. So just to throw another spanner in the works, gamma does change daily as well, but it doesn't change by anything near as much as what delta changes by. So we'll just use the same gamma figure for each potential outcome. And your profit in that scenario is $154 because we're getting to sell the put option now at 614 and we only bought it for 460. So that's a profit of 154. So we continue that for each $1 drop as we go on, and you can see eventually our delta gets to nearly -1. It can't go any lower than -1, and that's because now our option is so far in the money that for every $1 move in the share price, it's an equal dollar move in the value of the option. So look what happens now when the share price rises. So again, we're in day one. The share price is 56.38. This was the quote for our option. Our delta amount is minus 0.7658 and our gamma amount is 0.0633. So we get to day 2, the share price has gone up by $1, so now it's plus 1. You can see the value of our put option has gone down by the previous day delta's amount because the share price has gone up. So 455 minus 0.77 will give you 378, and 460 minus 0.77 will give you 383. You'll also notice here that our delta amount has now changed by the previous day's gamma amount. So because the share price has gone up, the gamma amount stays positive. So minus 0.7658 plus 0.0633 will give you minus 0.7025. And in that situation, we've made a loss of $82 per share because we bought the option at 460 and now we only get to sell it at 378. So that would be a loss of $82 per share. Now we get to day 2 and the share price has gone up another $1. You can see our put option has now gone down to 308 because we take the previous day options price and the delta, and that will bring us down to 308 because the share price has now gone up another $1. Our put option is becoming less valuable. Our delta has also changed from the previous day's delta amount plus the gamma amount. And our overall loss position is 152 because now the position is only worth 308 and we bought it for 460. So you can see, and so on and so forth, we continue to do that. So the net effect here as the share price is rising is that the value of our option is decreasing, but our delta is changing also. So this is important because if you're buying a put option and you're looking out for a certain target price to be reached before you sell, if it's before expiry, you're going to have time value left in that option. And this is the way of trying to put a value on what that option will be worth for certain share price outcomes. So gamma is always changing as well, folks, but it doesn't change by as much as what delta would change. So we're going to just use the gamma amount that we have as for this particular example.